Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so Steve mentioned the Australian dollar. Ironically enough, here we have the AUX, which is essentially the U.S. versus the Australian dollar. And the reason why I actually went to this today specifically is because a lot of the other pair values have just essentially gone parabolic with respect to their price moves. And so I essentially just illustrated that we really want to look at pivot points and so on and so forth. And if there are no pivot points to identify other than the the day's closing price, it's very tough for us to determine a directional bias. So what's interesting here, before I sort of carry on, is what we're seeing here is a level of indecision, and this was illustrated in our outlook this week. And so this is actually a great example, because realistically right now we're not sure what direction this is going to go. Steve mentioned the idea about people considering buying a call, buying a put, because you don't know. But again, recognize that that's an expensive proposition and may result in a less than favorable outcome if you've paid more than what the pair value actually moves in either direction. So here what we can do is we can stand back and we can very simply say, again, let me just get back there. We can very simply say, okay, if this is going to continue into a higher price zone, we need to see a break above a key pivot. Now, we've identified this level in here around the 152. We had a real significant spike here, but we feel, for example, that this 152 level is a key area of resistance. We actually played into that today. Incidentally, we did hit a high, I'm not sure 100% accurate, but of about 151.63, I believe, at one point I looked at it. So we're still trading below that 152 level. The idea is that if the market, if the pair value, the U.S. dollar again breaks into this higher price zone, then that opens the window for us to test these highs. One way that we can actually participate is, of course, we can go in and we can buy call options. Now, again, we talked about the confirmation of our lower indicators. Here I have our MACD in place, and the one thing that I just wanted to illustrate is that you'll notice that this is starting to cross down a little bit, which is conflicting with what our anticipated move is. So we really want to make sure there's some confirmation, and ultimately, as this breaks into a higher price range, you'll start to see your MACD suggesting that there's a trend continuing to the upside. But right now, it's kind of showing exactly what I'm suggesting, a little bit of indecision. It doesn't know whether it's coming or going right now. So we can go in and we can say, look, if the pair value breaks above 152, how can we participate? Well, one way is we can buy a call option. So what I've done here is I've just, as an example, I've picked a January 2009 150 call option. So what you're looking at here and what's highlighted is the contract information for that specific pair value. Now, I had no idea what the symbol was. All I knew is that I wanted to give myself a little bit of time, and I wanted to control this pair value close to where it's trading at currently. Keep in mind that in the options market, you can, depending on your time horizon, select a variety of different expiration months. The one thing that we like to teach is that for somebody that's novice at trading options, you want to give yourself a little bit of time, because the shorter the time frame you give, okay, the faster you have to be right. And when you give yourself a couple of months, you have a little bit of a buffer there where you can be wrong for a little bit and then be right, and not have to worry about risking the entire cost of your premium. Now, in saying that, you notice that these are pretty expensive premiums. Okay, so right now we're looking at the pair value here, the control of this particular pair value at the 150 mark, costing us $11.28. Now, that being said, we're actually looking at controlling 100, I guess, sort of theoretical shares of the underlying. So we need to multiply this by 100. So you'll see that the entire cost to buy in buying one of these contracts is going to be $1,128. Now, I see we have a question up in here, Steve. I don't know whether you want to just have a read through that and let me know if we need to address it right now. But I'll continue to move forward with this. Now, right now, what I can tell you is that I'm looking at my risk versus reward scenario here in paying that $1,228 or $11.28, and on expiration, if the pair value is at 165, I'm going to make my money back, okay, because this is the most that we can lose. This is our maximum loss, plus an additional $372, okay? So I may look to play out a few different scenarios to maybe find something that has a better risk versus reward ratio. But the one thing you have to always remember is that if this move happens extremely fast, we don't have to wait until expiration. Remember, we're paying all or very close to, well, we're paying all time value here. And as we know, time value depreciates the closer we get till expiration. So what this profit and loss chart is suggesting is that on expiration, all of the time value will have will have depreciated to the extent that when we hit this specific level, we will then make all of that time value premium back plus an additional $372, okay, to get out with our profit. Recognizing that if this happens very quickly over the next couple of weeks, most of this time premium, I'm not saying all, I can't, it's tough to determine how much, but a lot of this time premium we will still have, okay? So you have to keep that in mind. The faster this makes a move, the higher the rate of return we will be able to make. This is based on expiration, okay? So again, this particular level here represents the profit that we will make on expiration if the pair value is trading at 165 on the third Friday of January 2009. Okay, what's our break-even point? Well, it's the 161.28. So essentially, it's our strike price plus what we've paid for in our option premium. Okay. So the one, actually, I'm just going to backtrack on on that. The one thing that's important to note with this particular strategy is that, okay, you cannot, sorry guys, let me just go back here, is that you have an unlimited upside potential as the U.S. value goes up. So right at this point, if you anticipate a strong rally on the U.S. dollar and you don't want to limit your upside potential, then this is when you could go in and start and purchase just a straight call option at whichever expiration month you feel is appropriate to anticipate on an unlimited upside potential as the U.S. dollar goes up against the Australian dollar. Okay, and that gives you, if you purchase the January the January expiration month, that is in place from now until the third Friday of January 2009.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.